Welcome to Financial Planning Explained. I'm your host, Mike Menninger, certified financial planner, owner, and founder of Menninger and Associates Financial Planning. I'm pleased to have with me today Kelly Steyn, who is a realtor with Keller Williams. And interesting sort of twist today, she had asked for me to be interviewed for her because Kelly is also doing educational type of programs, and she asked to interview me, and it's like, oh, let's make this an episode for ourselves. So here we go. Kelly, thank you for joining me, or you're welcome for allowing me to join you.
Thank you so much for the opportunity in general. Thank you.
You're very welcome. You're very welcome. I look forward to it.
All right. So again, thanks for hosting me in your amazing office. It's very professional. I'm a little nervous.
You're nervous. I'm the one who's in the hot seat.
True. But you know that you're, like I said, you're very experienced. You know all this stuff. So I'm very excited to hear all your insight to help people. So first off, so when should people start working with financial advisor?
Well, it's an interesting question.
A loaded question.
You know, it's a loaded question. And fact of the matter is that I've always said that everyone could use a financial planner. And if you really get down to it, a financial planner is to a great extent very similar to a doctor, except just addressing different needs. When do you need a doctor? Well, you really ought to have a doctor who's maintaining and following your physical health, or someone that you see if you have a problem. As a financial advisor, we can provide all kinds of life assistance. You know, how do I get college funding, saving for retirement, saving for college? What do I do with my 401k? How much should I contribute? Should I go to traditional 401k, Roth 401k? Do I need an emergency fund? Should I have life insurance? Should I have disability insurance? How much? And, you know, I would like to retire. When can I retire? Do I have enough for retirement? Financial planning covers a very broad plethora of topics. So anybody could use a financial planner really at any time. What I believe in wholeheartedly is if you started in your 20s, it can make all the difference in the world when you're in your late 50s, because one of the things that I have found is that people in different demographic age groups think and behave differently. And I've noticed that in the years that I've been in this position, as well as following people through them. And what's really interesting is that it's right around age 60, plus or minus a few, that people begin to get tired of it. Or if they ever get laid off, it's a very difficult time to get another job, certainly making the kind of money that you have,
right,
or familiar with making. So if you do things early, it puts you in so much better of a position later on in life. Now, of course, the reality of it is that when do most people seemingly come to see a financial advisor is usually in their late 50s into their 60s when they're thinking about retirement. So the sooner you start it, the better served you're going to be later, because everything compounds on itself.
Right. So planning, which is all what we're about.
That is correct.
Sooner than later. I feel people get overwhelmed with everything financial advisors do. So that's why they put it off. They keep putting it off. And
possibly, or there's a lot of misnomers. People feel that they need to see a financial advisor only if they have money, or for good reason. A lot of people have had bad experiences with financial advisors, which I'm not surprised by. I think the industry has gotten better, but I will tell you that if you asked me 10, 15 years ago, I would have told you that 3/4 of the financial advisors out there, I don't trust. And it's not as bad today, but I will tell you that when I hear financial advisor, my immediate knee-jerk reaction is one of distrust. And that's sad about our industry, but it is what it is. So, again, people feel as though they only see a financial advisor if they have money. The reality of it is that a good financial advisor will provide direction and can be used at any time in your life.
Which leads to my other question of, do you only need a financial advisor to help with your retirement plan?
Absolutely not, because there's so many different things that, financial planners can do. They're helping you build wealth early on, helping you manage assets and debts. Do not underestimate the impact of managing your balance sheet, because you'd be surprised how many people have money saved in a savings account earning hardly anything. Meanwhile, they're carrying a lot of debt. And just being able to coordinate the two will be able to help. Furthermore, there's a whole lot of things you can be doing every year, particularly when you're younger, but really every year to maximize tax efficiency. Now, people think automatically that the accountants should do that. Accountants generally don't do tax planning unless you specifically ask them. They're there to do tax preparation. You do tax planning, and that can make a whole lot of difference. I mean, I could tell you there were a lot of clients that we deal with. We save them hundreds of thousands of dollars in taxes through their lifetime just by efficient tax planning. We're not talking about cheating, but efficient tax planning can help improve your cash flow and your ability to save for retirement. So it's not just about retirement planning. There's so many different things. Insurance planning, investment planning, estate planning really ought to be done when you have children. So it's not just about retirement planning, but that is when most people think to go see a financial advisor.
Yeah. And I've had clients that come to me that they're house hunting, and they talk to their financial advisor before their house hunt or even during their house hunt of, what is affordability? What's smart for me for the future?
Absolutely. In fact, that's another area which I didn't even think about when you asked when you should use a financial advisor. The advantage that we have over the realtor and the mortgage person is that we're unbiased and independent. And I don't mean to take that away from the realtor, but we are independent. I don't want to say I don't care if you buy the house or don't buy the house, but we'll help them with affordability, to your point. Is it best to take out a 15-year mortgage, a 30-year mortgage, an ARM? How much money should they put down? Do they do 80-10? Do they do 20% down? Do they consider the 3.5% down? There's a lot of moving parts that we can help with, not to mention that what a lot of particularly new homeowners or new home buyers don't realize that there's a lot of potential tax deductions that they get, which can have an impact on their cash flow. And if they get a lot of tax deductions, suddenly that gives them the ability to have extra money to withhold less from their paycheck to give them the ability to actually afford buying a house. Similarly, we're always concerned that people will buy more than what they can afford, and they find themselves house poor.
Yeah.
And that's no fun being house poor.
No. Well, that's our goal too. So I hear through reading and everything that I do with my planning, saving emergency funds. They are always like 3 to 6 months. I'm like, well, what is it? Is it 3 months, 6 months, 9 months? How do you know how much you should have in an emergency fund? And what's the smartest place to put that money?
Well, the easiest thing to say, the smartest place to put it is in a savings type of an account. We always say when it comes to investing, the single largest component of risk is time. Mm-hmm. If you don't need the money for 10 or 15 years, you can afford to take risk. If you need the money potentially in 6 months to 12 months, you shouldn't be taking any risk whatsoever. Last thing in the world you want is to put $10,000 away, need it, and it be less than 10.
Right.
So clearly the location to put an emergency reserve is in a savings account. Now, the question of how much is a great question. And you're right, 3 to 6 months is the rule of thumb. What people don't understand is, or let me rephrase, 3 to 6 months of what? Of income?
Right.
Expenses? It's generally expenses.
Yeah.
Okay. And is it 3 months or is it 6 months? Well, the reality of it is that how adequately insured are you? All right. What do I mean by that is that if you have all good insurances, then the only risk that you really have is the loss of your job. Mm-hmm. At which point, then you evaluate how risky is my job. If you're in a job that's in a union job and you've been there for 15 years and you basically can't get cut, then you have less of a concern. If you have a really good disability policy, then the loss of a job due to disability reduces the pain. So The answer to almost every question in our world, it sounds like a wise guy answer, which if you don't want to see a wise guy, this guy's the one, is it depends. Right. And it depends on the circumstances. And so rule of thumb, it's good to have 3 to 6 months of living expenses so that if you do lose your job or you have an emergency, most emergencies are insurable. Homeowners insurance, life insurance, disability insurance, medical insurance, they're mostly insurable. So the only thing that's not is losing your job or having a major, I say, disaster with your automobile, breaking down, needing $5,000 to cover an expense, needing money for your heating unit breaks down. That might be $10,000. Those are the types of emergencies you really ought to have enough money for. Now, one of the things that I have found is an alternative to an emergency savings is for those people who are homeowners, we have a tendency to recommend a home equity line of credit.
Okay.
Right? Home equity line of credit, as you know, is you have the ability to borrow against the equity in your home. Now, mind you, banks won't typically lend more than 80 or 90% of the value of your home. So what I mean by that is that if your home is worth $100,000, which good luck finding a $100,000 home, just makes the math easy for the viewers, is if you have a $100,000 home, if your mortgage is $60,000 and the bank will only allow 80%, 80% is $80,000, you can get a home equity line of credit for $20,000. The reason why I like the home equity line of credit is some people just don't have the ability to save for 3 to 6 months.
Mm-hmm.
Or what I'll use the home equity line of credit for is truly the emergency reserve. Because if they have debt that's costing them 20% with a credit card and they got the corresponding amount in savings, well, heck, I'd much rather see them take their savings and pay off the credit cards at a high rate, because truly the HELOC, the home equity line of credit, can serve as the emergency reserve. The only concern I have is if the first 2 words out of your mouth when you close on the line of credit are, woo, then that's not for you.
Right. Well, and I mean, there is an interest rate on the HELOC, but it's not as high as credit card. So
much less. And not only that, but the interest rate on the HELOC only exists if you have a balance on it.
Correct. So if you're actually using it. So
Correct.
That is a good point for having it as a safety.
Right.
Safety net.
I love it. And I use it all the time for folks as an emergency reserve because it frees up their assets. Yeah, because there are a lot of places you really could go if you had a true emergency, depending on the length of the emergency, how much you need. But there are a lot of other places one could possibly go. Not necessarily suggesting it, but they're like 401k loans, the bank of mom and dad, there's a lot of places one could go. And that's why really understanding a person's full picture as to how much they really need to have is determinant as to how much they should have.
Yeah. And the one other thing that I'll just note on there too, the commission based. So I'm commission based. There's other professions that are commission based. I read that maybe they should do closer to the 6 months because it could be, you're not losing your job, but you might, if you're commission, you might not have it.
Oh, okay. Right. So yeah, people who rely on that, you're right. Because effectively, you're not losing your job, but if you don't sell a house for 6 months, you effectively have no income.
Right.
All right. And that's at least,
and there's other commission jobs, right?
Right. There are plenty of them out there. And you're right. So those have the instability of income. And once again, it goes back to how stable is your income? Okay. How stable is your job? But that's another point that I didn't think about.
Yeah. Great. That was really helpful. So I think I work with a lot of people downsizing. They are retiring. Should someone, when they're talking about their estate, well, one, I know they should do that well before they're retiring. Should they bring you in? Should they bring a financial advisor in when they're doing their estate planning?
Great question. So we teach estate planning down at Temple and we teach estate planning locally. And one of the things that I would say, first of all, when it comes to estate planning takes on 2 phases or two components. One is who takes care of my dependent children if both of you pass away. Now I say both of you, it's important because if you have a husband and wife, one dies or something that goes to the other, right? And the other person's going to be the custodian and the raising of the children. The concern is if both people died. All right. So the one is who takes care of the dependent children. And then the second component is what happens to my assets. Okay. And so I think, at least let me rephrase, how we approach estate planning is this. We teach the client the fundamentals of estate planning. We believe in education and knowledge are powerful. Right. So we teach the fundamentals of estate planning so that they have the knowledge base going in to see an attorney. Now, mind you, you can do what I refer to as the TurboTax for wills,
Yeah.
the online will
Yeah.
program. Okay. And they have plenty of them. We have them. They could do that for a relatively simplistic will. If they really wanted to get into an estate planning type of scenario where they're trying to establish trusts, which are very important because people think, well, what do I need a trust for? I'm not worth that much. You may not think you're worth that much, but then all of a sudden you throw the value of your home, your 401k, and add the life insurance policies that you may have through work or outside of work.
Yeah.
Suddenly you're worth a whole lot more than you think. And do you really want to be thrusting your children with those types of assets? Not to mention, estate planning takes on the taxation of estates. How do you want to do it? How do you want to avoid it? So do they need a financial advisor? No, but I think what we can do is we can shed some light on the topic and the subject. Now, for clients that we have that are gigantic, we'll actually go to the estate attorney with the client.
Yeah.
So that inevitably what happens is they walk out. It makes all the sense in the world while they're in there. They walk out and they look at each other cross-eyed. What did he say again or she?
Yeah.
And at least if I'm there, what I can do is, because I can speak or at least understand the language, the financial advisor can come back to them afterwards and say, all right, let me explain what actually just happened, and explain to them in English as opposed to legal terms.
Yeah. Yeah. So you're saying, yes, it's good to have you collaborate with the whole.
I think it's a good idea because, we can bring thoughts together that, I say at least going in to see the estate attorney, it gives the ability for the client to really understand what's going on before they meet with the estate attorney.
Yeah, makes sense. On the topic of retirement too, how much do you guys practice or teach about how much you should have for retirement?
Love it. Okay. So we have so many episodes on it. The answer to every question is?
Depends.
It depends. That is absolutely correct. Good job. All right. Not everybody gets that the second time. That is a great question. And the answer absolutely is it depends. Because I'll go full range of the spectrum. It really comes down to two basic things. What is your cost of living? And what do you have? I say really three. And what do you have for assets, but other income sources? So cost of living is the most important thing. Okay.
Yeah.
We dig deeper. Just assume your cost of living is, say, $6,000 a month. One of the things to be cautious of that we always tell people typically underestimate their cost of living by about 30%.
Oh, wow.
What I suggest to people, if you want to really take a look at your cost of living, I suggest you take a look back over the last year and you look at your bank accounts. Did your bank account values go up or did they go down? If they remain the same, guess what? Your cost of living is equal to your pay. And which is I don't spend that much. Prove it. Your savings didn't go up. Therefore, you spent it. So we start with that and then recommend paring down deeper and saying, hey, what are you actually spending on? There are apps out there that you can follow and see how much you're spending. Then you take a look and say, well, you know what? I used to travel a lot for work out of my own pocket. That's going to go down. But then again, that pesky thing called work is no longer in the way of you being able to travel and go on vacation. So your cost of living is the most important thing because let me tell you, we've run so many estimates where people make it with flying colors on $7,000 a month and they fail miserably on $8,000.
Yeah.
Just $1,000 a month. You scratch your head. How can that possibly be? It depends also upon what your income sources are. Okay. If it's just Social Security, well, that's one thing. And then how much is your Social Security? And also, I will tell you when it comes to retirement planning, do not underestimate all the nuances with Social Security because there's a lot of ways to maximize benefits. But do you have a pension? So now, if I have a $5,000 a month pension and I've got another $5,000 a month between my Social Security and my spouse's, that's $10,000 a month. If my cost of living is $7,000, how much do I really need to save? Not a lot.
Right.
But if my cost of living is $10,000 a month and I've only got $5,000, do I have enough in my savings? Now, then the next question is what type of savings do you have? If it's pre-tax, then guess what? The IRS is lurking around the corner in retirement, because as you're taking money out of your retirement plans, your 401k, your IRAs, the federal government's reaching into your pocket to take some of it. So it's not how much you make, it's how much you keep. And lastly, the two really important components that people tend to forget, if that's the right word, is medical or medical insurance, meaning your Medicare premiums, your supplemental insurance, and inflation.
Mhm.
Inflation is really tough. And in fact, inflation for older folks is higher than inflation for younger folks. And the reason is because look at us. Our single largest expense on a monthly basis is what?
Probably housing.
The mortgage.
Mortgage, yeah.
Right. So if you're retired, the odds are that mortgage is gone. And not only
Hopefully.
that, but your mortgage is fixed. Okay. So if you have a $2,000 a month mortgage, it's basically fixed with the exception of taxes might go up, but that's a fixed cost, whereby the inflation on that is very close to zero.
Okay.
You throw that mortgage out and you're in retirement. Now all of a sudden that big piece at 0% is gone. All of the other pieces now take on a bigger percentage of your overall cost of living, and healthcare expenses rise at a much more rapid rate, particularly for retirees.
All right. So it depends.
It depends.
That's why you're here. That's why
right.
we need you.
It depends on a lot of things. And it also depends on the rate of return that you receive on your investments in retirement.
I have a question because that popped up in my head when you were talking about Social Security. Do you know what your Social Security will be?
Oh, yeah.
You can estimate that?
Yes.
Like I can?
Yes.
Oh, okay.
Okay. There you go. I didn't know you didn't know. So it's great. So what you do is basically, it's ssa.gov.
Okay.
All right. Back in the day, which was only about 10 years ago, everybody 3 months before their birthday would get the green statement. Do you remember it?
I do remember getting that.
And it went away. People forgot that it went away until one day they're like, hey, whatever. Well, the reason is because there was a cost associated with doing it. The federal government sent it out to 300 million people. There's a cost for doing it. So what they did is they stopped doing it, but then they would start it once you turn age 60. But that's fine. What you have the ability to do is to go into ssa.gov.
Okay.
All right. When you go in there, you basically register yourself. It asks a lot of the security questions, which are interesting security questions. And I've seen these before where like, does this address mean anything to you? And it pulls an address from 25 years ago.
Yeah.
Okay. And does this loan payment mean anything to you? And sure enough, it was a car loan that I had in 1995.
Yeah.
So it does ask those questions. But in any case, you register. Once you do, then you have the ability to print out your statement. Okay. Then you also have the ability to do a retirement estimate. And what's important to understand about your statement and a retirement estimate, your statement, you should really understand that your statement is potentially misleading. Now, you remember your green statements, right?
Yeah.
They're not green anymore. They're like blue and red. Those statements assume you make the same amount of money you made last year every year from now until the time that you retire. And if you understand how Social Security is calculated, it's calculated on your highest 35 years of income. So if you put up a big number last year, then it's going to assume you're making that number every year until you begin to collect Social Security. Furthermore, people will look at their age 62 and their 67 numbers or their age 70 numbers. It's assuming that they're still making that big number all the way through. But if you retire at age 60, you're no longer adding to the pot. So you have the ability to go in there and say, well, I think I'm going to be making X number of dollars and retiring at a particular age. What will it be at these different ages? Okay.
And that makes sense because I guess it refreshes every year after taxes to see what you made every year in the previous year.
Yes.
Very interesting.
Yeah. You ought to take a look at it. It's very interesting. It's not as good as it used to be. What it used to do is, and it was very nostalgic, because I used to be able to take a look at my green statements and I could tell you all the way back from the time that I was working part-time at 14 years old, how much money I made every year since like 1978. It's kind of cool.
Yeah.
Kind of cool. You see a couple zeros in their odds when you're in college or whatever the case may be. So it's pretty cool. It's actually a very interesting thing. They stopped that now and they put them in decades, but then starting at 2000, they show every year.
Interesting. All right. Definitely have to check that out.
Yeah, it's cool.
It helps you plan too. Right.
Oh, it does. It does. Oh, it absolutely. I mean, it's part of the financial planning process, particularly as people are getting older and approaching retirement. We do ask, as part of the financial planning process, that they provide theirs and their spouse's social security statements. Because from there, if one is higher than the other, then it really facilitates social security planning, meaning who takes it when and delays it and so on and so forth.
All right. Well, I think that's all the questions I have, but do you have any last minute tips or advice that you want to give the audience?
Goodness.
One best tip.
My goodness, there's no best tip. Nobody plans to fail. People fail to plan. That's an old cliche. Mm-hmm. I have one that I learned. Proper prior planning prevents poor performance.
Oh my gosh.
There's a
say that again?
I left it out. Proper prior planning prevents poor performance.
Okay.
That's the 6 piece. We have 7 around here, but we slip an extra one in there. It never hurts to plan. And the reality of it is that when it comes to financial planning, what people fail to realize is a lot of the things they don't count. Remember, I referenced people underestimate by 30% because they don't include discretionary income as well as things that they weren't planning on. It happens. We all know it. It happens. Car repairs, gifts, Christmas. You don't plan on that. People just look, well, this is my mortgage. These are my bills. And they go off of that. And that's usually the smallest part.
One thing I read recently was that when you're retiring and you're going to move closer to your grandkids, you're likely going to spend more.
That's also.
So you need to calculate that.
Factor that in.
You might not be traveling to go see them as much, but you're going to see them and there's going to be more expenses probably.
Absolutely. The other thing too is that people don't realize is what state are you retiring in? Okay. And there are states that tax higher than others.
Yeah.
For retirement income. For instance, if you're collecting money from a pension or from your 401k or from IRAs, in some states it's taxable and in other states it's not. And so if you think that you're going to be moving to a high tax state, there are things you're going to want to do now. If you live in a high tax state and think you're going to move to a lower tax state, there are things you want to do now. So again, it all comes down to planning because I always say it's not how much you make, it's how much you keep. And when it comes to tax planning, there's a lot of tax planning that can and really ought to be done. And one of the things that I have found is right now we are in the lowest income tax bracket system we've ever been in. And I can assure you that it is unsustainable because as a country, we're falling further and further behind with debt.
Right.
And so I can look people in the eye who are making 400 grand and say, you are in a lower tax bracket today than you will be in retirement. And then they look at me cross-eyed like I have two heads. And when I show them, it's shocking. It is absolutely the case. And so therefore, not all the time, but in many cases, so therefore it really comes down to planning. And I really believe that if anyone went through a comprehensive financial analysis of all that they have going on, they're going to come out of it with so many ideas and ways with which they can improve efficiency.
Yeah, it's really good. Thank you. It's really
You're welcome.
helpful. Thank you so much. And thank you again for hosting me in your lovely office.
You're very welcome. And thank you for joining us for Financial Planning Explained. I hope everybody had the opportunity to learn something. And we look forward to seeing you on our next episode. Have a wonderful, wonderful day. Thank you for watching this episode of Financial Planning Explained. We strive to provide an educational experience for all of our viewers, and what we struggle with at times is topics. So if there is an idea or a topic that you would like for us to discuss on a future episode, please email us at admin@maaplanning.com, or you may enter it on the Contact Us page on our website at www.maaplanning.com. Thank you in advance for participating and helping make our show successful.